Happy New Year. My name's Matthew Boersen, and I'm the managing partner of Straight Path Wealth Management. Today I wanted to talk to you a little bit about 2023, the next 12 months, and what that could mean for the economy as well as your portfolio. We've identified 3 themes that we think will remain through the next 12 months that will have an impact on you, your investments, and the economy as a whole. So when we look at those first 3, our first one that we look at is something that is a holdover from 2022, and that is inflation and interest rates. It's something we talked about constantly in 2022 and the end of 2021, and it will continue here for at least the next few months. Inflation has been high and continues to be high, although it seems like maybe it's peaked and is starting to come back down just a little bit. What higher inflation has done is it's led the Federal Reserve to have to feel like they increase interest rates to try to slow the economy down just a little bit. And so we've had really high inflation because interest rates haven't had its intended effect yet, while simultaneously having those high interest rates. And so figuring out what we think is going to happen over the next 12 months, what the Federal Reserve may do, if we're going to continue to have high inflation, if we're going to continue to have increasing interest rates, or if we're going to get a little bit more of a stable economy, will be key for bonds and the stock market as a whole. Secondly, the theme that we're looking at is recession. It's been the big word that everyone's talking about, but we haven't actually seen it truly hit yet. But our concern is that we may talk ourselves into a recession. Media has talked about and said the R word for almost a year now, and people are starting to almost believe it's happening even before the data says it is. This graph here shows us what the NBER's recession measures are and the different areas and the different things that they look at to determine are we in a recession or not. You can see on the far right side of that graph that primarily we still are in yellow and green, which still means that we're sitting pretty good. The red slices you see inside that graph are actually from 2020 during COVID when the economy just shut down. And we're not anywhere close to anything that we've seen during that time period. Additionally, if you look at the bottom of the graph, the different things that contribute to GDP looks pretty good outside of the wholesale and retail sales. And so the economy still seems to be functioning really well. The question is, does everyone get so nervous? Do companies get so conservative that we start talking ourselves into a recession and we start having a little bit of a pullback inside GDP? We're watching that very closely, positioning the portfolios appropriately for that. What is an important thing to remember, though, is even if the economy does start to slip, that doesn't necessarily mean the stock market will go along with that. Many times the stock market is looking a year, 2 or 3 years ahead, and to some degree the stock market's already priced in the fact that maybe a recession may be coming in the near future. So we could absolutely be in the spot where we get recessionary data from an economy standpoint, but simultaneously the market starts to rally because it had already priced in that possibility. The third theme that we're looking at is the strength of the dollar. And this has been a theme that has been going on for years, but the US dollar has gotten increasingly stronger and stronger and stronger comparative to other foreign currencies. This graph shows over the last 10 years the growth of the dollar comparative to currencies like the yen and the euro. The dollar has increased significantly, which impacts overall GDP growth here in the US and our import and export trade imbalances, and also impacts the international investing and the returns that we see here as US investors. If the US dollar starts to retrace and go back to normal, like what we'd expect long-term to be, and have a normal relationship with some of these currencies that's more in line with its historical mean, that could mean a couple things. It would mean that the US's economy might start exporting things more to other countries and we might import things less. That's actually good long-term from a GDP standpoint. What it would also mean is we as US investors holding international investments would start to see an even better return. For the last 5 to 10 years, international investments have underperformed US investments, partly because the US dollar has been so strong and it's hurt the performance of those other investments. If the dollar starts to go back down, that's something that could help international investments, while actually also include helping the US start to recover and create more sustainable GDP as we start exporting more products. And so with those 3 things, interest rates with inflation, are we going to talk ourselves into a recession, and then the strength of the dollar are the 3 main topics that we're looking at right now in January of 2023, and the 3 main topics that we think will impact your portfolio and the economy over the next 12 months. We appreciate you listening, and we look forward to talking soon.